Hi, and welcome back. So in previous videos, we've talked about selling options and how it allows us to put the probability of success in our favor. So now we've established that selling options is better and we want to be selling options. What strike prices should we be selling? In this video, I'm going to be talking about options delta and how I use delta when I'm setting up my trades so that I have a high probability of success when I'm selling options. So for this video, I'm going to be using Microsoft as an example. But I'm sure by now you already know the drill. This is just for illustration purposes only and not intended to be taken as investment advice. Alright, so let's take a look at the options chain for Microsoft. What we're looking for is the column that has the heading delta. This column represents the delta for the call options, and this column represents the delta for the put options. Delta is the most basic of the option Greek, so it should be there. Your broker should provide you with this column. If you can't find it, maybe you want to play around with some of your settings. And if you really can't find it, then it might be time to change brokers. Okay, I'm going to quickly go through what delta is. Okay, let's get all the theory out of the way so that we can move on to the good stuff. What we have here is the textbook definition of delta. So it is an expression of the rate of change in the option prices based on changes in the underlying share price. This call option has a delta of 0.24. What this means is that if the share price of Microsoft were to increase by $1, the price of this option would increase by 24 cents. Likewise, if the share price of Microsoft were to fall by $1, then the price of this option would fall by 24 cents. Over on the put option side, this put option has a delta of negative 0.74. So if the share price of Microsoft were to increase by $1, then the price of this put option will decrease by 74 cents. And if the share price of Microsoft were to fall by $1, then the price of this put option will increase by 74 cents. What we can also observe is that delta is represented as a number with 2 decimal places, and it is for call options it is between 0 and 1. For put options, this number will be between 0 and negative 1. So the delta on the call options is positive and delta on put options is negative. So for call options, the further out of the money are the option strikes, the delta will be closer to 0. The further in the money the option strikes are, the delta will be closer to 1. For put options, the further out of the money are the option strikes, the delta will be closer to 0. And the further in the money the option strikes are, the delta will be closer to negative 1. At the money call options, the delta will be the closest to 0.5. And at the money put options, the delta will be the closest to negative 0.5. How then do I use delta when I am trading? So remember, options have intrinsic value and extrinsic value. When we use option selling strategies, we are actually selling options that are out of the money that have no intrinsic value. Our goal is that these options are going to remain out of the money by expiration date because extrinsic value declines over time and eventually goes to 0. Delta gives us a theoretical probability that an option will be in the money on its expiration date. For example, an out of the money call option, like this one here, it has a delta of 0.32, and what this means is that theoretically it has a 32% probability of becoming in the money by the expiration date. Whereas if you look at a call option that is, deep in the money, like let's say this 280 call option, it has a delta of 0.92, and what this means is that it has a 92% probability of being in the money on expiration date. At the money options, the ones with the strike prices closest to the current market price, because they're kind of sitting on the line, right, between in the money and out of the money. So pretty much they have a 50-50 chance. And that's why their delta is the closest to 0.5 for call options and negative 0.5 for put options. As option sellers, remember our aim is for the options that we sell to remain out of the money by expiration date. So when we sell options, we want to look for options that have a low probability of becoming in the money options. And we can use delta to give us the theoretical probabilities. If I was bullish on this stock and I want to sell this put option with a delta of negative 0.22, I would have a 78% chance of making money on this trade. Now, if I was bearish and I want to sell this call option with a delta of 0.18, basically I would have an 80% chance of being correct and making money on this trade. So this is an example of how we can use the option delta to help us to identify high probability trades. The delta can tell us which strikes, right, of the option contracts we should be selling in order to get high probability of returns. Alright, now I'm going to do a quick demonstration using Microsoft, but remember this is just an example. This is the price chart of Microsoft. We can see that in the last market session, it made a really sharp upward movement. Let's say now I think that the share price is going to consolidate for a few months before it continues in its upward movement. I want to sell a bear call spread on Microsoft, so I'm expecting the share prices to remain below a certain level, and let's say I want to have maybe a 75% probability of making money on my bear call spread. I would choose the option with a delta that is the closest to 0.25, and in this case it is the 340 strike price. So I will sell this option, and for protection I will buy the option that is one strike further out of the money. So that will be the 345 call option. So we can see that this is my bear call spread. It has a 75% probability of profit. I will collect a premium of $1.21 as long as the share price of Microsoft remains below $340 over the next 2 months. I'll make the maximum gain of $121. And if I'm wrong and the share price of Microsoft were to increase above $340, no matter how high it goes, the most that I will lose is $379. So this gives me a return of 32%. So essentially, by executing this trade, I have a 75% chance of making a 32% return on my capital. In an upcoming video in this series, we're going to be talking about what is the optimum amount of premium we can receive so that we can increase our return while still maintaining a good probability of success. So that's all for today's video. Like, comment, and subscribe if you found it to be helpful, and I will see you in the next video.